Many community interest companies are under the impression that because they're CICs, community interest companies, they don't have to pay tax over to HMRC. I wish that were true. Unfortunately, that's not the case, and there's a common misunderstanding. In this week's I Hate Numbers video, I'm going to outline what the main tax issues are in respect to CICs, so hopefully you can draw from that and understand your tax position carefully. If you need any questions answered on that, then by all means, there'll be a contact details at the end of the video, and by all means, please do use that. Hi folks, my name is Mahmood. I'm a business finance fixer and coach, author of the book I Hate Numbers, and founder of the accounting firm I Hate Numbers. And for many years, I've helped hundreds of business owners make more money, increase their financial literacy, reduce their stress and anxiety, and I want that for you. Let's progress on with the video. Now, a CIC is a community interest company. It's typically a model that's used by individuals who want to get together to form what's called a social enterprise organisation. That's where they have an entrepreneurial trading motivation, but they also want to do some good for the community that they're serving. Whether that community is well defined by a particular geographical location, or it could be of a much wider base. Now, being a CIC, a community interest company, in itself does not make you a charity. Charity organisations which have got a particular structure in the United Kingdom by what they do in terms of generating surpluses, if those surpluses are used for charitable purposes, they tend to be exempt from paying tax on that. However, a CIC is not a charity, it's a different model. Now, in your community interest company, you'll be subject to a variety of taxes. So let's have a look at the first one, and that is where your CIC, at the end of its accounting period, has made a surplus. So the level of income that it has generated, whether that's from straight commercial activity, whether that's from grant funding, perhaps donations that it receives, if you take into account all the expenses it can offset against that, there may be a surplus that arises at the end of that financial period. Now, that in itself, that surplus, that profit, is not exempt from corporation tax. There is no exemption given in the legislation for CICs to be exempt from tax on their profits. The other taxes that you are likely to also be exposed to is VAT. Now, VAT is a tax that's made on what's called taxable supplies. So if your income is predominantly from grant income, it's unlikely that you're going to be subject to VAT, i.e. charging VAT on the value of the supplies that you make. However, if you've got commercial activity there, so you're running workshops, for example, for which you're charging a fee, you're doing some individual consulting for which you're charging a fee, those are going to be considered taxable supplies in the context of VAT. Once they reach that magic 85,000 over a 12-month period, then you will have to register for VAT. You're not going to be immune from that, and again, you'll be treated like any other private entity or organisation in the context of VAT and corporation tax. Other taxes that you need to be aware of: if you employ people, then there's potentially you're going to be subject to employers' national insurance contributions. You're going to also have to act as a tax collector to deduct tax and national insurance off your employees. So in large part, the normal tax rules that apply to private companies will also tend to apply to CICs. Now, take into account, by the way, within a CIC, you can either be a CIC that's called limited by guarantee, or there are other forms of CICs which can be limited by shares. If you are a CIC that's got a share capital in there, then any dividends that you pay out to your shareholders will not count as a tax expense itself. Now, as a footnote, folks, if you happen to be in receipt of grant income is typically for delivery of a project, delivery of an outcome. Those grants can be received at local authority level, can be received from international funders, can be also receivable by organisations like the Arts Council. That project grant that you receive will be for delivery of a project activity which will span your accounting year. That may require you to adjust that grant income and only include the amount that's relevant for your current financial year. But fundamentally, if you're generating surpluses, you're making profits there, do not expect exemption from corporation tax. If, however, you're a charity in that same situation and those profits were being used for the benefit of your beneficiaries, to deliver those services, to meet your charitable objectives, then they will be exempt. But we're talking CICs here, not charities. Folks, if you found this video useful, you think there are others in your network that could benefit, I'd love it if you could share the link to the video as well. If you're a CIC and you want to find out more, then check out the bank of videos that we've got that cover CICs. If you feel there's something you want covered in a future video, let me know in the comments below and we can add that to our content list. Until next time, folks, I'll see you on the other side.